Bismillahirrahmanirrahim. Today we'll start our next chapter, which is related to stock exchange, security markets, and trading procedures and different other aspects of Pakistan Stock Exchange. So, starting with the little bit information regarding the security markets. When we talk about security markets, there are two types of security markets. One is primary market, and the other one is secondary market. Primary market is actually a market for a new issue of securities. Obviously, when the company decided to issue stocks or bonds and any other type of security, they'll issue these securities through different mechanisms. Like they can also go to investment bank, or they can directly advertise their IPOs, that is initial public offering. So that is called as the primary market. So primary market is the market for securities which are issued for the first time by the companies. On the other hand, we have another market that is called as secondary market. Secondary market is actually those markets which the already sold or already issued securities are being brought and sold by investors, and this type of market is called as stock exchange. There are the stock exchange in different countries and all over the world. Pakistan has its own stock exchange that is called as Pakistan Stock Exchange. Previously, we have three stock exchanges: Karachi Stock Exchange, then we had Islamabad Stock Exchange, then we have Lahore Stock Exchange. But as all these exchanges have different rules, and they have different bodies, so there were lack of compatibility in between these different stock exchanges. So in order to eliminate different differences and incompatible incompatibilities in these stock exchanges, one comprehensive stock exchange was developed that is called as Pakistan Stock Exchange. Like I have said that primary market is actually a market in which the IPOs are being conducted, that is called as initial public offering. And initial public offering is actually a procedure in which stocks are offered by the company to the general public for the first time. That can be done by the company themselves through their website, or through advertisement in different print media, or they can hire, or they can get the services of any investment bank who are specialized in issuing or selling securities of different companies, and in return they can get overwriting fee in order to sell the securities. And there is another kind of IPOs that is called a seasonal issue. These are new issue are offered by companies that already have floated equity. So these are the issues. These seasonal issues are done by the companies who have already have issued stock, and they want to increase their equity portion, or they want to increase their holdings of common stock or preferred stock. So these are called as seasonal issue. Then when we talk a primary issue, so companies may choose to sell securities either through public offering or private placement. Like when we talk about offering through public, so obviously it is done through investment bank and many other type of sources. Or when we talk about private placement, so private placement is the type of method in which the securities are offered to wealthy individual, or individual of selected financial institutions, like that was called as institutional investments. You can offer these investment or offer these kind of securities to these wealthy investors in order to get a large amount of sum from a well financially stable source, or you can say stable institution. or any type of individual. Then when we talk about private placement, so there are different advantages associated with these private placement, because these are offering to individuals or wealthy institutions. So they have very less registration and legal cost, and when we see this cost is in US, so it's almost a dollar 20,000. So registration of the security with SCP is not required. That you don't have to register to it registered with a Securities Exchange Commission. And another advantage is that these you can raise fund very quickly through private placement, because you are directly one-to-one contact with these individuals, so you don't have to wait for individual investors, or wait for people who can contribute only few amount, and in few I can say in few days you can generate more amount of money through these private placement, as compared to when we compare it with IPOs. It's take almost 4 months. So private placement is rather a quickly way of getting money from the investors. So then another feature of this private placement is that these private placement are not traded in on stock exchanges. As IPOs, securities which are being issued by IPOs, they are liquid, because they are being offered in the secondary market, and they can be bought and sold in the secondary market. But these type of private placement are less liquid, because they are not offered in the stock exchange, and they cannot be traded on this stock exchange. um, and as when you want to indulge these investors into your business, and you want to get investment from them, in return you have to give them a high rate of return, because if they cannot sell their these private placement in the stock market, so their money is being fixed in the business, or making it illiquid. So that's why you have to pay a high rate of return to these investors in order to retain their investment in your business. Now, how securities are sold in initial public offerings. As securities are offered to the general public, mostly with the help of these investment bankers, and companies, or these investment these companies who want to offer these securities to the general public, they can get the help of these investment bankers, and they can get their advice. They can by underwriting and distribution of securities. As investment bankers are expert in selling these securities, so their advice matter a lot to the companies, and or they can also get the underwriting fees from these companies, in order to get the reward for their selling efforts, and also they distribute the securities of these companies. So first of all, these investment banker underwrites these new securities by purchasing these securities from the company who is issuing these securities. And as they purchase these securities, so they will bear the loss of selling these securities to the general public, because obviously there are certain aspects in which the certain securities are not being sold. So, and all these risk is beared by the company, and by the investment banker, and this is being beared by the investment banker, so they can get the underwriting fee for such type of agreement. And this agreement is called as firm commitment, because they are committed that they'll sell these securities, and they will try to sell all the securities of the company. And on the other hand, in contrast to firm commitment, there is another agreement which is called as best effort, where in this type of agreement, this investment banker will purchase those securities. Do not purchase these securities, but they can make an agreement that they will make their best effort to sell the security at good price good price. So in this case, all this risk was not bared by investment bankers, but they can give their best effort in order to sell these securities due to their expertise, due to their experience. Secondary market, as we have discussed about primary market, which is actually market for the securities which are being issued by the companies for the first time. And once these securities are being issued by the primary market, the buying and selling of these securities are done in secondary market. And as these are the these type of markets will increase the liquidity of securities which are being which are being issued in primary market. And these are the actually in secondary market, many type of securities are being brought and sold, like common stock, bonds, put and call options, and many type of futures. So all these type of securities are being traded in these security markets. And these markets also include brokers market and dealers market, because majority of time these brokers and dealers are there to make the deals of different type of securities, as people hire or investors hire these brokers and dealers for buying and selling of these securities. Now, when it comes to broker market, these are also called stock exchange, or it actually is an association of brokers and workers, just like an auction market. When it comes to stock exchange, all these brokers and dealers are being hired by the investor, because investors are not directly allowed to buy and sell securities in the stock market. So these brokers and brokers are being hired by different investor for trading of their securities. And in return, the brokers charge commission on transaction they made for their clients, because the brokers have their experience, they have their links with different type of other brokers. Secondly, they can easily assess that what type of securities are worth purchasing, and what securities have to be sold out. So they can help the investor gain better return, or get a potential return on their investments. These brokers are the people who can buy and sell securities for their clients or investors. Now, in case of dealer market, as brokers are being hired by their clients or their the different investors for buying and selling of securities, dealer buy, or they are also called as market deal makers, buy and sell securities for themselves. They are not representing anyone. They are buying and purchasing and selling their securities for themselves. And these market maker deals in number of securities and keep a specific quantity of given securities, depending upon the profitability of that security, depending upon the future incentive and future of that company, and different aspects of that company. They can keep a specific number of securities with them. And they try to buy and sell a given security at the same time. Now, trading at a stock exchange. As we already know that the investor cannot directly trade in stock exchanges, so therefore they have to open an account with brokerage houses. And when it comes to Pakistan Stock Exchange, there are different brokerage houses, and they can allow an initial deposit of 1 lakh, or a certain brokerage houses also allow 50 to 25,000 as well. There are almost 400 brokerage houses in Pakistan Stock Exchange, and also there are 21 asset management companies. And up to May 2020, there were about 540 companies which were listed in Pakistan Stock Exchange, with the total capitalization of which are 398,456.068 million Pakistani rupees, which actually constitute 52 billion US dollar in January 2021. So these are the latest statistics of Pakistan Stock Exchange. Now, once the investor opens an account with the any type of or any kind of brokerage house, they can ask its broker to purchase a certain number of shares for him. So when such kind of order is placed with brokerage house, that is called as bid order, because the investor wants to purchase certain securities, therefore it is called as bid order. On the other hand, when an investor wants to sell its shares, so that is called as offer orders, because they want their shares to be sold in the market, so they are offering their shares in the market, therefore it is called as offer orders. When these orders are classified, there are mainly two type of orders. One is limit order and the second one is market orders. First of all, we will discuss limit orders. When an investor specify the price at which he is willing to buy this or sell such orders, that are called as limit order, because they have given limit to its the broker, that at this certain price, or not lower than this price or not higher than this price, they can buy shares, or not lower than this price they can sell shares. So they have limited their orders, and they have certain limited limits in which they want to sell or purchase their shares. So limit orders are sorted on the basis of price, and then on first come and first serve basis. Uh, First come serve basis means that once these orders are being placed, so whoever comes first or place their order, they will be entertained. So bid order with highest bid price are placed at the top. Obviously, the orders with the highest bid, highest bid means that when you want to purchase a certain type of securities in certain price, so if you are offering a higher price, so you are placed at the top position, or if you want to buy certain shares at lower price, so your order would be placed at lower levels. And offer price with lowest offer price are placed at the top, because when you want to when we want to purchase shares, so obviously the higher price would be preferred. But on the other hand, if a certain company or certain companies want to, or want certain investor want to sell their shares, so lower prices of the shares would be actually attracted to the other investors. So therefore, in case of offer orders, or when you want to sell certain type of shares, so lowest offer price are placed at the top. Then another thing is order sorting. Order with similar prices are sorted on the basis of first come first basis. Obviously, when whoever comes first who will get the that shares, or who that shares are being sold. So order at the top are fulfilled first. Limit orders are fulfilled only when matching price is available. Like obviously you have given a limit that a bid order of 100 share at rupees 30 each will have to wait until someone offers this share at rupees 30. As you have placed an order and you have said that you want to buy 100 shares, and that shares would be of 30 rupees per each share. So if you will if the broker, or if the broker will find such kind of shares, or such certain specified shares, so obviously then you will be entertained. So limit orders are fulfilled neither below nor above the price at which they are placed, because there is limit to it. So you can that shares could not be buy at higher prices or lower price based upon their limit, and quantity matching is not necessary. almost if certain shares are available, if you have placed order of 100 shares and only 60 or 70 shares are available, so in that case those shares would be purchased. So quantity is matching is not required, but over here price matching is required, because the order is placed at certain price, so you have to purchase or sell a certain shares at certain price, but quantity could be increased or decreased. Now we can explain this order sorting with the help of this example. First of all, there is a bid order of 5,000 share of NML which is placed, and 70 per share is required. An investor want to purchase 5,000 shares of NML at rupees 50 per 70 per share. So obviously this is the only order, therefore it is placed at the one, and it is actually a bid order. Obviously it is placed at the bid portion. Then and there is another investor who wants to buy bids 100 shares of NML at rupees 70.01. So 70.01 is higher than 70, therefore this order is placed at top of the previous order, that is $70 per share. So then an order for sale of 3,000 share of NML at rupees 72 is placed. An investor wants to sell its 3,000 shares of NML, but they want to sell it at 72 per share, 72 rupees per share. So this is placed at the bid at this offer portion, and they are actually placed as the top, because this is the only offer order. Then the fourth one is actually a purchase order of 700 shares at rupees 70.01 is placed. So this is actually placed at the second, and the third, or the first, the order which was placed at the first, which wants to buy the 5,000 share of with 70 rupees per share, it is placed at the third portion, and there is no change in the offer order, because that is the only offer order and there is no matching in that. Then someone offers 1,000 shares of NML at rupees 70.01. So if we look into the this box, so you can see that there is only one bid offer left, that is 5,000. That and there were previously two orders, which bid orders, which were 100 for 100, which want to buy 70.01 per share, and there was another order of 700 who want to purchase share of NML at 70.01. So both orders are entertained, because an investor wants to sell their share at 70.01. Now from 1,000 share, only 2,000 shares are left at order, because the 800 shares were purchased by the previous investors who want to buy it at 70.01. Then a bid order to buy 1,000 share at market is placed. There is another bid who want to buy 1,000 share at marketplace is placed. So in this case only 2,200 shares are left at this, because there was no price was placed, 1,000 shares are being sold, and now only there are 2,200 shares were left at which are being offered at 72, and the first bid order is not entertained, because they want to buy share at 70 per share. So this order is not entertained, because the price is not matched. Now, market orders, orders that are executed immediately at current placed limit orders. That means that these orders are being placed, and certain limit is also ordered, but still they are executed immediately, and if the market order is not completely fulfilled from the top limit order, it is fulfilled from the next limit order in the sequence. Like you are not limiting this transaction, but you have offered or you have asked your broker to purchase or purchase certain type of securities, and you have ordered them a limit, but if that limit is not met, you can go to the next limit if which is available. So these orders are executed at the immediately at placed limit orders. Now there are different types of limit orders. First of all is a stop loss order. This type of order is placed by the investor to its broker, that if they want to sold a security, if a certain level of price is not met, or if they have declined at certain from certain level. So in order to avoid any type of losses or unexpected losses, they can order their investor to sell that security if they decline from certain limits. And when there when there is uncertainty in the market, and a market you cannot forecast a future very clearly, so in that case also you can place this stop loss order. And if you look into the Pakistan Stock Exchange, in a day there are almost 5% variation in the prices. So if the investor sees, or the broker sees, that the and the 3% loss is there in the price of the security, so they can stop loss order, place stop loss order, and they can avoid 2% loss if anything abnormal happens in the stock market, because in Pakistan Stock Exchange only 5% variation is actually maximum variation of 5% is allowed. Therefore, if there is 3% decline in the price, and if this or stop loss order is placed, so in this case the company or the investor can avoid 2% loss if any abnormal loss or any abnormal thing happens in the prices of the stock. Then another type of order is stop buy order. It is actually as opposite to loss order. So in this case, it's specified that a stock should be bought when price of security rises about a limit. Like if there are security has a certain amount, price has increased, and security has increased up to a certain limit, so it would become attractive for the investor, because they can assume that the prices of that security would increase in the future as well, or increasing in the wealth of this investor. So in this case they can order to buy that type of security, and it is usually used with short sell to limit possible losses from short position. Like in this case, uh, the when you want to sell certain type of securities in the future, and you can and you don't want to make loss from making a short position, or short position is when you want to sell security. So in that case you can use this stop buy order, and at this in Pakistan Stock Exchange, order has a validity of 1 day. When you can place this order for maximum up to 1 day. This order is valid up to 1 day. Now settlement at Pakistan Stock Exchange, and when the order are being placed, whether it is bid order or a offer order, so these order are executed within 2 working days. This requirement is called T+2, that transaction in 2 working days. A purchaser delivers the cash to his broker, who deliver it to the seller's broker, because the brokers are involved in this. So the price is being paid to the broker, and from one broker to the other broker, and broker net out their transaction each day, and only net quantity is transferred or received, because brokers also charge their commission fee. So this commission fee is being cut from the broker, as they retain their commission fee, and the net amount is transferred into the investor's account. So investor may keep shares in CDC account, or may keep physical shares. So central depository, CDC is central depository, so they can keep their shares at central depository, or they can keep their physical shares with them. Mostly these shares are placed as the CDC. Now, if we look in this diagram, we have two investors. One is Bilal and the Ali, and the other one is Ali. and Bilal purchased 100 shares from Ali. These are the broker of Bilal is Kasab, and Ali's broker is Life Securities. So first of all, Bilal has to purchase 100 shares. Kasab pays cash to NCPL. NCPL is actually a clearinghouse facility provided by Pakistan Stock Exchange. So in this case, the and the Kasab will pay 100 price of 100 shares to NCPL, and Life Securities provide shares to NCPL, and then obviously they will provide cash to Life Securities because the cash is being paid by Kasab to NCPL. In NCPL, 100 shares of Kasab it will be added, and cash would be deducted of 100 shares. And in case of Life Securities, 100 shares were deducted, and cash of Life is added. Now this cash is paid to Life Securities, which is actually transferred to Ali account. Then these Life Securities deliver 100 shares to NCPL, which actually transferred these 100 shares to Kasab, obviously, and these are being kept in name of Bilal, because these shares are being purchased by Bilal through Kasab, which is a secure brokerage house. So this is actually the whole process, and NCPL is actually provided as role of a clearing house, in which the shares in cash is being transferred to each party. Now, if we have more than one investors, and because the broker house had a number of investor, so in this case we have two brokers. One is broker one, and second is broker two. In broker one we have three investors: investor A, investor B, and investor C. And in the second broker we have investor X, Y, and Z. So in this case, if we suppose A sells 4,000 shares of NML to Z, and suppose C buys 5,000 share of NML from Y. So broker 2 must provide 1,000 shares to broker 1 within 3 days. So obviously this netting is done through this clearing house, because 4,000 shares are being sold from A to Z. But if we look that only these 5,000 shares are also being bought by C from Y, therefore the net amount of shares would be transferred from one broker house to two broker house, in order to avoid certain transaction fee or any other type of extra charges.